This is Nightly Business Report with Sue Herrera and Bill Griffin.
What a run. The S&P 500 hits an intraday all-time high, and the bull market ties the record for the longest ever as the summer rally accelerates. But the proverbial wall of worry that stocks are said to climb acquired more bricks late today. A guilty plea from the president's former lawyer and a guilty verdict for his one-time campaign chairman. Hard as steel, but not immune to tariffs. We'll take you inside a manufacturer in Holland, Michigan. Those stories and more tonight on Nightly Business Report for Tuesday, August 21st. Good evening, everyone, and welcome. I'm Tyler Matheson. Sue Herrera is on assignment, and Bill Griffith is off tonight. Well, the S&P 500 came oh so close to finishing the session at a record, but a late-day pullback left the index just below its highest close since January. It did, however, hit an intraday high. That's good for something, and it was a record finish for the small-cap index, the mid-cap stock index, and the critical Dow Transportation Index. Here are the closing numbers. The Dow Jones Industrial Average rose 63 points to finish at 25,822. NASDAQ up 38, and the S&P added 5. Bob Pisani now with a look at what's behind the move higher today.
Stocks soared to fresh highs. The S&P 500 breaking through its all-time high hit back in January, though it didn't close at a new high. Small and mid-cap stocks, along with the Dow Transports, also hit new highs. Another notable milestone, the stock market has now tied its previous record for the longest bull run in history. That run started in 1990. It ended when the dot-com bubble burst back in 2000. So why does this rally just keep on rolling along day after day? Well, tax cuts and strong corporate earnings are, of course, a big part of that equation. But there's also been strong sector rotation. So when growth stocks like technology stocks and semiconductors pull back, consumer stocks have stepped in to take their place. And retail's also been on a tear. And healthcare stocks like biotech and pharmaceutical stocks, they've hit new highs. So every time we fall back, the market seems to find a way to just still hold up. Traders don't just sell everything and leave, they buy new stuff. But beyond just the S&P 500, we've seen breakouts to record highs in a number of sectors. Everything from small cap companies, mid cap companies, and the Dow Transports. Airline names were doing well, and that's given a big boost to the transports. All right, so what could kill the bull market? The two classic killers of a bull market and things that cause bear markets are first, a recession, and second, Federal Reserve that suddenly gets overly aggressive with raising interest rates. So far, there's no signs of either of those happening. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
And meantime today, Wall Street keeping a close eye on a courtroom in New York City where President Trump's former personal lawyer, Michael Cohen, struck a plea deal with federal prosecutors. He pleaded guilty today to a variety of charges, including tax fraud and making false statements to a financial institution. He also and significantly admitted to violating campaign finance laws at the direction of a candidate for federal office. He arranged to make payments for the principal purpose of influencing the election. That caused stock futures to drop after the market closed. And separately, President Trump's former campaign manager was found guilty on 8 of 18 counts involving financial crimes. So clearly there is political risk in this market, but what else could cause the bull to grow claws and turn into a bear? Dominic Chu takes a look.
The baseball analogies about the market are all over the place. Are we in the early innings, the middle, or perhaps the ninth inning of a bull market? Maybe it's the extra innings after seeing the S&P 500 index more than quadruple since the depths of the financial crisis back in 2009. Economist David Rosenberg at Gluskin Sheff thinks the rally is on borrowed time and lays out 5 reasons why. Number one is the job market. There's a big skills gap in America with millions of unfilled jobs and just not enough qualified people to do them. Number two is wage inflation. A tighter labor market could mean higher pay, but if coupled with higher prices for goods due to increased tariffs, we might see the Federal Reserve move more quickly to raise interest rates. The third is the growth in money supply, like cash and checking accounts and savings accounts. That slowing growth in cash is showing signs of perhaps a slowing economy. The fourth is a housing market that appears to have peaked. That's playing noticeably out in the markets where there is still a number of downtrends in early place from the highs for home building stocks. And fifth, he says, it looks like markets are past the peak in the credit cycle, with problems starting to show in investment-grade bonds. By now, we've all heard the bullish case for the stock market. Corporate profits are still growing. The full positive effects of the Trump tax cuts have not yet been fully realized, and the U.S. economy is better off than many others around the globe. But with stocks setting fresh record highs in what is going to be the longest bull market in history, some traders are making sure they're aware of any potential downside risks. For Nightly Business Report, I'm Dominic Chu.
So what happens next to the market? Joining us to talk about that is Teague Sanders, portfolio manager and co-manager of small cap investment strategy at Whittier Trust. Teague, welcome. Good to have you with us.
Thanks for having me.
Let's start with the day's late news, and that is the guilty plea by President Trump's former personal lawyer, Mr. Cohen, in a case that now involves campaign finance violations that he says were made at the direction of the president. Does this introduce a political headline risk into the broader market that is more than the market can withstand?
Well, I think the last part of your statement is the most important thing. I mean, there's definitely been geopolitical risk ongoing for a while. These are not new allegations. We've seen this coming for a little bit of time. The fact that we got 8 plea convictions is a little bit interesting, but I don't think it's too much for the market to withstand. I mean, we've seen broad fundamental strength across a number of industries. So I think at the end of the day, the market will be able to digest this. We will be able to move forward. But it's definitely adding to this geopolitical narrative of we don't really know what's happening in the White House. We have Vladimir Putin and some other exogenous factors trying to influence what's happening here locally. And yet we've seen earnings growth of 20%. We've seen 4% GDP growth, and yet wage inflation is only 2.7%. So from a market perspective and a fundamental perspective, we're in a bit of a Goldilocks scenario where it's not too hot, not too cold. But to your point, there's a lot of geopolitical tension ongoing right now.
Yeah, and a lot of things as we go into what is historically, seasonally, not the most favorable months of the year for equities, September and October. But be that as it may, let's turn to your specialty, small cap shares, which have been doing very, very well lately. Do you predict that that will continue? And why are they doing so well?
We do think this is going to continue for the fundamental reasons I outlined before, but from a small cap perspective, they continue to benefit from a number of different things. There's tax reform ongoing. There's the fact that less revenue actually come from international sources, so the geopolitical tensions are less impactful for small cap U.S. equities. You also have the fact that small cap supply chains are less multinational, and so these tariffs, they're a little more insulated from the tariff bubble that's being created around it. And finally, a regulatory reform happening across a number of different industries. Now, if we see this geopolitical tension and this political narrative kind of unhinge a few of these aspects, that could shift, but we think the markets overall are strong enough to get through that.
All right, so the little guys may rule for a little while longer. Teague Sanders, thanks very much.
Exactly.
Teague is with Whittier Trust. Well, meantime, Microsoft says Russian hackers linked to cyber attacks during the 2016 election are now widening their targets to include the upcoming midterms as well as conservative groups. The company took down 6 domains last week that were registered to a Russian hacking group.
There is no doubt in our minds that this is the same group that was responsible for attacks in the United States during the 2016 elections. There is no doubt in our minds that this is the same group that targeted every major presidential candidate last spring in France.
Microsoft says it has no evidence that the hackers had succeeded in compromising any user credentials before it took control of the malicious sites. Now to trade, the auto industry is breathing a sigh of relief, at least for now. The Wall Street Journal reports that the Trump administration will likely push back its timetable for imposing tariffs on auto imports. The White House said in the past, has said that it is considering 20 or 25% tariffs, something the auto industry has vigorously opposed. But one manufacturer in Holland, Michigan, is trying to navigate the financial fallout from the trade war. Our Leslie Picker has the story tonight.
Here at TransMatic's headquarters in Holland, Michigan, the fallout of the steel tariffs hit practically overnight once they were announced in March. TransMatic uses mostly domestic steel, but the cost of the coils coming onto TransMatic's factory floor have soared as U.S. steelmakers boosted their prices by 25%. That steel is then stamped into components for auto parts, door locks, and plumbing materials and shipped to customers all over the world. So far, the higher costs are being passed on to customers, but eventually TransMatic expects they will chase lower prices abroad, buying those same parts cheaper from TransMatic's competitors in Europe and Asia.
In a trade war, which is essentially what we're in, there are clear winners and clear losers, and unfortunately there's a lot of collateral damage, and people's lives and livelihoods are put between the crosshairs.
If the tariffs stay in place, TransMatic may need to transfer production to its overseas plants in Mexico and China in order to stay viable against the competition, even if that means rolling back hours and investment here at their headquarters in Holland, Michigan.
Trade uncertainty hitting home for the factory workers.
We unfortunately fall into that area that it doesn't really help. So it would be nice that it did, but it just doesn't.
A little bit of nerves, I guess, what might come if they continue to go the way they're going. But short term, we haven't felt that on the floor yet.
TransMatic employs about 300 people in Holland, and manufacturing represents about 1/3 of the lakeside town's economy. So the tariffs have raised questions for the local government as well.
You don't really know how it all is going to end and how long the tariffs would last and how it would affect down the food chain. When the manufacturers are nervous about it, we're nervous about it too.
To add insult to injury, TransMatic is bracing for possible retaliatory tariffs from China on some of the products it exports there. It would be yet another new twist for this 50-year-old family-owned and managed company and the thousands like it across America. For Nightly Business Report, I'm Leslie Picker, Holland, Michigan.
Time to take a look at some of today's upgrades and downgrades. Discovery upgraded to buy from hold at Jefferies. The analyst there cites several opportunities that could increase the company's free cash flow, including stronger U.S. distribution growth. The price target now $34 a share, and shares rose today more than 5% to $29.55. Symantec was upgraded to positive from neutral at Susquehanna. The analyst cites the potential for change following the involvement by activist shareholder Starboard Value. The price target, $23. The stock rose about 1% to $19.55. And Estee Lauder was upgraded to buy from neutral at D.A. Davidson. The analyst says the company's fundamentals are, quote, the strongest seen in years. Price target now $167. The stock did, however, fall nearly 3% to $136.63. And still ahead, a big bank jumps feet first into no-cost investing. And it could change retail trading as we know it. Well, we usually tell you about startups that are trying to disrupt industries, and today, though, it is an old-timer's turn to do just that. The nation's largest bank is jumping into low-cost investing, and in this case, free investing. JP Morgan will launch an app that lets customers trade online at no cost. It comes at a time when competition to attract investors has been heating up, a trend that has pressured fees downward across the industry. And today's news from JP sent shares of discount brokers, as you see there, lower, sometimes a lot lower. Joining us now to talk more about this new service and what it could mean for investors is Gerard Cassidy, Managing Director and Banking Analyst at RBC Capital Markets. Gerard, let's turn first to JP Morgan stock. Is it a good move for them to be offering no-fee trades? Is it good business?
I think it is, Tyler, and the reason being is that what JP Morgan is trying to do is, with this approach, two particular strategies. The first is to offer an additional product to their existing customer base. They want a greater share of that customer's wallet, and by offering this product, they'll be able to do that. But second, they're also looking to build the new customer base. And by offering this product, they can get new customers into the door. The new customers can take a look at not only this product, but other consumer products that JP Morgan offers. So it's a two-pronged strategy. And then lastly, it's also a focus on the millennial generation, where many of them really haven't invested. And this is a way for them to test out investing without very high costs to them at all.
So it is, in effect, a lure that JP Morgan will then employ to cross-sell products.
That's right. It's a strategy that JP Morgan uses throughout their business. They do it on the corporate side, where they'll make a commercial loan to a customer, and over time they hope to sell that customer additional products. Same thing with the consumer. If you and I have a credit card with Chase Manhattan, we'll obviously be approached about other types of consumer products, and this is just another arrow in the quiver for JP Morgan.
It's an app. It'll appear on your phone. If you don't already have the app, I assume it'll be added to the app you have. It's an app that you can use on your computer. That's one thing. But is this really the bell being rung that says we are beginning a race to the bottom in terms of fees and charges that will affect all the online brokerages?
That's the $64,000 question, because when you think back to the 1975 deregulation of retail commissions, you might recall so-called May Day. That's when they deregulated the commissions, and that's what introduced discount brokers like Charles Schwab. And rates of trading, or the commissions that people paid, has steadily declined. This is just a continuation of that long-term trend. And you're right, it's going to cost, obviously, the online brokers some revenues if this catches on. The other thing we got to wonder about is, what about the other universal banks? If JP Morgan really gains traction here and starts to take market share, you have to wonder if a Wells Fargo or a Bank of America is going to employ a similar strategy.
Gerard, thank you for your perspectives tonight. We appreciate it. Gerard Cassidy is with RBC Capital Markets. Well, customer traffic rises for the 16th straight quarter at TJX, and that is where we begin tonight's Market Focus. The off-price retailer that operates TJ Maxx and Home Goods, my wife's favorite store, grew same-store sales at a quicker than expected pace at all of its divisions as new customers were eager to snatch up discounted items. TJX expects that measure to remain strong throughout the end of the year, and it also hiked its profit forecast for 2018. Shares of TJX up more than 4% to 106.46. Kohl's decision to scale back promotions seems to be working. The retailer sold more merchandise at full price this quarter, and that helped overall earnings top estimates. The company also raised its profit outlook for the full year, but the new figure was shy of Wall Street expectations, and shares climbed more than 1.5%, nonetheless, to $80.20. And J.M. Smucker topped profit estimates but missed on revenue as demand for its core products like Jif peanut butter and Folgers coffee fizzled a bit. The company also cut its sales guidance for the full year. Shares of J.M. Smucker off more than 6% on the session to 108.20. And the medical device maker Medtronic set a rise in sales for its diabetes and heart products, helped overall earnings and sales edge past expectations. The company also raised its organic revenue growth output for fiscal 2019. Shares finished up nearly 6% to 95.17. Well, if earnings results from Toll Brothers are any indication, the housing market in America is alive and kicking. The luxury home builder said demand was strong across the country, and that sent the stock up 13% in today's session. But the same is not true for all high-end markets. Manhattan, famous for its luxury listings, is sending mixed signals, decidedly mixed ones, and Diana Olick has the story.
It could be a record-breaking year for Pennsylvania-based homebuilder Toll Brothers. The company beat expectations in its third quarter report and raised guidance for the full year, saying revenue could hit a new high.
The two parts of the market that we think are still pretty strong are that first-time, low-cost entry-level buyer and then the upper end.
Toll homes carry a median price tag of about $850,000, nearly 3 times that of all other newly built homes. So its buyers are not exactly on the margins and not super sensitive to slowly rising mortgage rates. CEO Doug Yearley said the company was not seeing affordability issues, But he did note a slight softening in California, where prices are highest and new tax laws that limit deductions hurt more.
The federal government has essentially extracted itself from the homeownership promotion business, and it really is going to take a couple of years for buyers and sellers to recalibrate whether it's the overall market or the luxury market.
That's a big reason why luxury sales are now plummeting in New York City. That and a sharp pullback by international buyers who favor condominiums.
Participation's down by about half. And the key reason has been the currency play, that the dollar is stronger, so their money doesn't go as far. And the other part is that they can see the excess supply that's in the market, so there's less upside potential.
Manhattan luxury home sales fell 17% annually in the second quarter of this year, according to Douglas Elliman, luxury being the top 10% of the market. The weakness was worst in condos, with sales down 20% annually and prices down 8%. While Manhattan is literally an island unto itself, sales of higher-priced homes in the rest of the nation are strong, thanks to a stronger economy and more high-end supply. That is not the case at all in the bulk of the market, where listings are very limited and both sales and affordability are weakening. For Nightly Business Report, I'm Diana Olick in Washington.
Coming up, the sector that helped drive the bull market with many twists and turns along the way. The Food and Drug Administration is extending the expiration date of some lots of EpiPens, the move designed to help mitigate the national shortage of the medicine. The life-saving drug would be good for an additional 4 months now, says the FDA. The agency approved the first generic competitor last week, but it will take a few months for it to reach the market. Well, we return now to our lead story, the big bull market. As we mentioned, tomorrow it will become the longest of all time. And as Bertha Coombs reports, the biotech sector played a big role in the run higher.
For investors, biotech has been a roller coaster ride during the market's bull run. Big gains early in the decade, then a 20% plunge in 2016, when presidential candidates vowed to crack down on high drug prices. But now, biotech's back at record highs, fueled by hope over new drugs that treat and even cure difficult diseases.
For the last couple of years, there's been a huge breakthrough in some of the transformative medicines like gene therapy and cell therapy. You had some new FDA approvals of some of those important new drugs. And so there really has been a big breakthrough in some of the new technologies for new biotech medicines.
For investors who could stomach the volatility, taking a risk on these novel drug makers has paid off with healthy returns. The hands-down best performer, Jazz Pharmaceuticals, which launched a blockbuster drug for excessive sleepiness last year. It's gained 30,000% from the 2009 market bottom. Investors saw impressive gains as well from specialty drug makers Neurocrine Biosciences, Incyte Pharmaceuticals, and Regeneron, all up about 3,000% or more, while Parkinson's treatment maker Acadia gained 1,500%. But some of those long-term winners are now lagging this year. Acadia Pharma is grappling with reports of negative side effects of its key drug, while pricing issues have weighed on Regeneron. Its Eylea blindness treatment could be impacted by new Medicare Advantage rules on physician-infused drugs. And Incyte has already faced lower prices on a key drug. Trump administration's pushback on high prices is an increasing headwind for the pharma industry. But analyst Michael Yee expects the specialty drug players will continue to outperform.
You have some challenges at some of the large biotechs and large pharmaceutical companies. And those challenges over the next few years have driven a likely move towards acquiring many of the smaller and mid-cap biotechs. We believe that many of these other earlier stage biotechs could be acquired. So there's a lot of enthusiasm for the speed at which these companies are developing drugs and the potential for them to be taken out.
Still, the price tag of some of these new drugs in the pipeline that offer cures will be in the $1 million range, which will pose a real challenge for the nation's health system. For Nightly Business Report, I'm Bertha Coombs.
And that is Nightly Business Report for tonight. I'm Tyler Matheson. We want to remind you that this is the time of year your public television station seeks your support. We thank you and have a great evening. We'll see you tomorrow.